Hi, everybody. Thank you for joining us today. We're excited to present our investment opportunity for Waterpark at Briarwood. Dennis, our Chief Investment Officer, is going to hit some highlights for this investment, and we will have time for Q&A for a few questions after he finishes. There's a Q&A box at the top of your screen. You can put your questions in there, and we'll go through them at the end of the presentation. And without further ado, Dennis, I'll turn it over to you.
Thanks, Laura. Appreciate it. And thank you all for taking time today to learn a little bit more about our latest investment offering, Waterpark at Briarwood. Happy St. Patrick's Day. Save the green beer for later. Let's learn a little bit about the market and a great opportunity right now. Before I begin, just some housekeeping, a basic disclaimer to share with all of you so you understand. This presentation is for informational purposes only. Any offer to invest with us is done through a private placement memorandum. This is only for accredited investors through a 506c offering, and we recommend you always conduct your own due diligence and consult with all your relevant advisors before making an investment decision. Before I go into the investment opportunity itself, I know we've got a lot of first-time registrants on this webinar, so I just want to give you a high-level summary about Sentinel Net Lease, the sponsor of this investment offering. We created Sentinel Net Lease in late 2019, and really we were looking at it as a way to democratize real estate investing and offering Wall Street caliber investments for Main Street investors. We have over 425 different investors on our platform from all across the United States and internationally. Since our inception, we've acquired about $335 million worth of assets, totaling 2.2 million square feet across 14 states. We've acquired 25 different properties over that time. The vast majority of those were done during individual syndications. Recently, we launched Sentinel Opportunity Fund 1. And in that fund structure is where we buy most of our assets, but we allow sidecar opportunities for outside fund investors, which is what you're seeing today. Some notable metrics for our firm. Since our inception, we've averaged 11.4% net cash on cash to our investors from just lease income alone. And so if you compare that to a lot of other sectors in commercial real estate right now, you'll see we're beating that quite handily. And that's because we really take a needle in a haystack approach to our opportunities. We're never going to be a $10 billion firm because I don't think there's enough compelling investment opportunities in the market to be able to deploy that level of capital. So we're very strategic on what we acquire. We're very basis oriented, and we only buy stabilized assets. So we're not taking construction risk. We're not taking lease up risk. We're buying something that creates great cash flow from day one. And as a result of our diligence and analysis when we acquire these properties, it's turned out pretty well for us when we've decided to sell as well. So we've had 3 exits within Sentinel so far. The average net IRR to our investors has been over 28%. One other great feature, and the reason we are called Sentinel Net Lease, is because we primarily focused on net lease investments in the office, retail, and industrial space. One of the benefits of net leases is obviously that the vast majority of operating expenses are passed on to the tenant, and that allows us to be able to deliver a much more consistent level of returns as we originally underwrite, because a lot of those surprises that may come up when you're owning a building, those are passed through to the tenant in most situations. And because of that, again, since our inception, we've been able to deliver 99.2% of our actual cash on cash versus our projections. So really right in line with targets. And the industry has taken notice as well. We've won a number of awards in commercial real estate and technology, including top 10 emerging investment firm and best of the best owners. So just a little bit about us. Our key personnel, I'm Dennis Cisterna. I'm the Chief Investment Officer. I co-founded the company with my partner, Fred Lewis, and we have a great stable of institutionally trained professionals within our organization. Almost everybody in the firm has at least 15 years of experience. And for some of our younger employees, they come from institutionally trained areas across commercial real estate as well. So as a platform, we're very much tech driven. We use a lot of tools and software to enhance not only our decision-making process, but to provide greater visibility and transparency to you as an investor. Because our backgrounds are in the institutional side of real estate, we're really excellent on the capital market side of things, able to structure these deals appropriately, able to go secure reasonable debt from a wide variety of partners, whether it's CMBS, life cos, regional banks. On our average deal, we go out to 140 different lending institutions to ensure we get the best terms possible. And then, of course, even in net lease deals, asset management is critical. And so we're very forward thinking on that front. And we think building those relationships with our tenants, even in net lease scenarios, is critical to drive that future success. We want to know about potential problems years before they can happen. And so that proactive approach has served us well. And then our operational support team, we've got a great roster of third-party vendors and professional organizations that help us, from legal, title, banking, accounting, property management, and these are all household names you would be used to in the commercial real estate sector. And then we've got a great tech stack that really enables us to do best-in-class acquisition, asset management, and reporting for our investors. Moving into the opportunity itself. So I'm really excited to be able to present this. It's been a long time since we've been able to show an investment opportunity to investors outside of our fund. And so this property, Waterpark at Briarwood, it's 2 individual Class A flex office buildings in Sentinel, which is a great suburb of Denver. A couple of the elements I want to highlight here. Each building is about a little over 70,000 square feet. They were both built in the year 2000 and underwent substantial renovation in 2021, which I'll get into. Amazingly, the weighted average lease term between these 2 buildings, and each building is occupied by a single tenant. So we don't have to worry about a bunch of roll from a bunch of little tenants. These are mission critical pieces of real estate for each organization that occupies each building. But we've got almost 12 years of lease term remaining on average between these 2 buildings. That projects a 10% plus cash on cash return from lease income alone. In fact, over the next 10 years, although we're not planning on holding the property that long, it averages a 13.6 net cash on cash return to our investors. So that's obviously well beyond your principal investment into this deal that you're getting back from cash flow alone. And because we think we're buying this at an incredible basis, due to a variety of market conditions, we think we're in a really good spot to add additional profitability from the disposition of the asset. As I mentioned before, talking about net leases, so this is a double net plus lease on both of these properties. And that means that almost all of those operating expenses are being passed along to the tenant, risking your exposure and reducing volatility in the income stream of that asset. Also, a good feature here is that these leases were signed in the middle of COVID, so some pretty favorable terms for the tenant. But what that means for us is that these leases are 35% below market value. So in the future, we're in a great spot to not only retain these tenants, but if for any reason they did decide to leave, again, very long term, we've got a huge mark to market from the rents as well. Now, one thing, if you don't know Sentinel, both my partner and I have lending backgrounds, so we are big stalwarts when it comes to credit and credit enhancements of our tenants. And so in this situation, we were able to procure $3.2 million in additional seller-funded credits that would offset future capital expenditures and potential releasing costs. Huge win for us. We're acquiring the property for $23 million as it is, which is just $155 per square foot. For those of you curious about what the replacement cost on these properties is, for the biotechny facility, it's about $350 a square foot. And for the quantum facility, because they've added a data center with huge energy and cooling infrastructure, it's about $450 a square foot. So again, a big fraction, just a fraction of the replacement cost for these buildings, which is another nice enhancement. These buildings are Class A flex office, and some of you maybe you don't know what that means, but with the flex office, it means you have an ability to have other uses outside of office, which is what is being used here. On the quantum building, they have a data center, and we'll go into this in more detail. They have lab space. On the biotechny building, they have lab space, cold storage, um, and a couple other elements. Their global IT center that they've built there. And so that flex office really works well for companies that need more than just the traditional office setting. And that actually proves well when you look at the actual submarket trends for this type of product. The vacancy for this type of product in this submarket is less than 5%, which is way under the office statistics and vacancy rates for anywhere in the country right now. So good favorable trends on that side of things. We're also acquiring it at an attractive cap rate north of 9%. We're putting highly accretive debt on this through CMBS, and we think that is giving us a great position to create, as I mentioned before, great strong cash on cash levered returns. Our tenants on these buildings are both publicly traded, Biotechny with nearly $2 billion in revenue, and Quantum with nearly $300 million in revenue in high growth sectors, biotech, and also technology storage, data storage. One of the most compelling elements of this investment is that since 2021 and when these two tenants occupied this building, there's been nearly 16.6 million, I'm sorry, over 16.6 million in tenant funded improvements, including labs, IT, cold storage, data center. Really a phenomenal lift on these properties that's already occurred. And so that provides tremendous value for any future tenants, in addition to the stickiness for these tenants because of the investment they've made into these properties. And again, just to highlight the long-term lease security, Biotechny lease through 2034, Quantum lease through 2037. So really long-term leases. And if you look at our overall projections for this, we think we're going to generate close to 20% IRR. That is an extremely high level of return for a stabilized asset, but I think it speaks volumes about our basis. And overall, that is a projected multiple on invested capital of 2.2. We think we're going to hold on to the asset for 5 years. We're going to dig into the financial summary real quick here. So you'll see that we're raising a total of almost $9.8 million. The majority of that capital is actually coming from our fund, Sentinel Opportunity Fund 1, and we're allowing about $4.5 million to come from outside investors who aren't eligible or have not invested in our fund previously. As you can see here, looking at the 5-year hold, you'll see that the return on invested capital, that's your net distribution per year, 9.2%, 9.2, 9.9, 12. Overall, you are averaging over 10% just from lease income alone during that 5-year hold period. And our basic strategy here is that we think it's somewhere between years 4 and 8 that interest rates and cap rates could compress, especially for assets like this, and that gives us a window to offer an incentive for an early renewal for both tenants. That increases that WALT, which is important to any net lease investor, and as a result, that gives us a lower cap rate. Those leasing costs, they're not going to have to happen up front either. That would just be a credit to the buyer. So as soon as those extensions occurred, we would just give a credit to the end buyer as well. We're financing this property with approximately 62% of loan to cost through UBS, who is our CMBS lender on this. Like I mentioned before, we've got $3.2 million in change in a seller credit. And then as the equity from the GP, we are putting in 5% of that capital ourselves on top of our fund, putting in close to 50% of the overall dollars coming in. Now, right now, we're assuming the final interest rate will be 7%. As some of you may know, treasuries have moved inside, which is the base index for CMBS borrowing. It has moved inside where we initially signed the term sheet. So we might actually get some more favorable terms upon closing, but we're just trying to remain conservative here with ultimately what we think the final interest rate will be. And this is a 5-year fixed rate interest only loan. And we will be putting substantial reserves into escrow for both capital expenditures as well as potential releasing costs, as mentioned previously. We like to always include a return sensitivity matrix so you can understand exactly what happens to the return profile if we sell at a lower or a higher cap rate than what we've estimated. So we use a 300 bip spread here from 575 all the way to 875. I think you'll be pleased to see that even at the higher cap rates of 8.75, we're still generating nearly a 15% IRR, which is again incredible for a stabilized asset without any construction or leasing risk. And that generates a 1.8 net equity multiple to our investors. Looking at the alternative scenario, and my apologies if my voice goes in and out. I'm recovering from a cough right now, so doing my best. In our alternative scenario, we really try to get negative. And in this scenario, we assume Quantum, who is the weaker of the two tenants, defaults on their lease and vacates the building. So not that that's ever a good thing, but in this scenario, we're prepared for it. And so by that, I mean, number one, Quantum's in-place rent is well below market. So we'd get a nice boost to the building level NOI. And on top of that, we have a $1.2 million credit and change to account for those releasing and vacancy costs. So we're in a great spot where we're prepared for that downside scenario to occur. Even better, if they don't default, we have this $1.2 million credit that we still keep regardless, and we'll talk about that in a minute as well. But even in this downside scenario, where we bring a new tenant in, which may result in a credit enhancement if they're a stronger financial tenant, ultimately we're still generating a very strong IRR and equity multiple for our investors. For those of you that aren't familiar with cost segregation, that's something that allows us to depreciate and hyper depreciate assets within the property. So that accelerated depreciation allows us to have some tax efficiencies. In this scenario, because we're at the lower scale from federal tax guidelines of how much we're allowed that bonus depreciation. Let's say you invested $100,000 in this deal. You're going to get distributions for 8 months, but the depreciation is going to offset the income by 3x. So even though you created income in the property in 2025, your K1 is going to show as a loss of $14,000. So that helps offset any other K1 income you may have from other investments. So just a nice little feature that we put into the deal. Moving into the property itself, and I'll move through this relatively quickly because all of this is available on the investment summary, which you can download from the Waterpark website. So as I mentioned, situated in Sentinel, it's an affluent suburb in the southeast of Denver. Great schools, low crime, a lot of housing options, a lot of amenities. In fact, our buildings are located right next to the Topgolf in this area. So it's got a great hub of aerospace, engineering, telecom, a lot of single tenant office concentration in the area, which is good for us. We think that's buildings of our size, especially with flex office, make a lot of sense for HQ and single tenant locations, and great proximity to a lot of hotels and the Sentinel Airport, which is just to the south. So the site plan, you'll see where the two buildings in the middle. This complex consists of 4 buildings. We've got a substantial amount of parking, averaging 5 spaces per 1,000 square feet. That parking ratio of 5.0 is above average for the Denver market. So we think we've got a great advantage there. And both of these buildings being only 74,000 square feet, that may seem like a big building to you, but that's bite size relative to the Denver market. And so buildings of this size are in demand because they're few and far between. Couple photos of the building. It's been very well maintained since it was created and constructed in 2000. And again, a lot of renovations in 2001. Most of those on the interior of the building, but you'll see it's in great shape. Tilt-up concrete construction, lasts forever, very clean, easy to maintain, and we're pretty happy about that. I'm going to talk about some of the capital expenditures that we're going to take into account and start on soon after we close on the property. You'll see that parking lot there is a little beat up. That's one of that first phase of capital expenditures that we'll use seller credits to be able to repair. Interior, both tenants have done a phenomenal job of the build outs. These are next generation improvements. On the top row of photos here, you'll see Biotechni's lobby area with stairs going up to their second area, which is mostly office. They have a great dining facility and recreation area for their employees. They've got a lot of cold storage. They hold a lot of lab samples in these cold storage areas, and they've got some great built-out conference areas as well. They have a fabulous fitness facility there as well. And then on the bottom, you'll see Quantum's lobby and reception area on the left, one of their testing rooms next to that. And then to the right, one of the many areas that holds server racks and serves as a data center or lab testing facility for some of their data center rack products. Going over some of the uses of the floor plans themselves with Biotechni. Like I said, they've got a lot of lab and cold storage area. That's mainly on the first floor. Shipping and distribution with a distribution bay at the rear of the property, which is great. They've also relocated Biotechni's global IT command center into this building. So really mission critical function where all of their global IT functions for their operation in 34 different countries is run through this. In addition, this is the headquarter of their subsidiary Novus as well. And as I mentioned during the photos, they've got some great employee amenities with the cafe, dining area, recreation area amenities, and great fitness property as well. Looking at Quantum, Quantum did an even more extensive build out of that first floor. And if you look at everything in the top there, where you see that it is light blue, orange, green, even the blue, these are all server racks. So a lot of data center space, a lot of data labs where they're testing their products. They have a very cool product that's a robotic arm that uses that moves data tapes into server racks so it can actively be pulled. Imagine you're watching an NBA game and they want to pull up a highlight from Michael Jordan in 1986. Well, they're not saving that on the cloud. They're saving that in a data tape. And because they have time to pull it, it's a much more cost-efficient use for them to store this historical old footage. So a lot of their customers are NASA, municipalities that use traffic light footage, the FBI. Really great technology that's cutting edge and is a good alternative to cloud storage. In any case, on the second floor, they've built this executive briefing center, which is where when the C-suite comes into town, when they're doing demos and selling to any of the large Fortune 500 government contracts, that's where they're pitching that facility. And they've got great build out of office space on the second floor as well. Again, really move-in ready space for that. But as when we interviewed the CFO, he was very transparent about this. He said our business cannot function without this building. So we thought that was an incredible element for him to share with us about how sticky this building is, how important it is to their long-term plans as a company. Okay, looking at the capital expenditure and maintenance plan. As I mentioned, we negotiated a $1.3 million credit from the seller to cover the parking lot repaving, roof replacement, and some other incidental items that we're going to schedule during the first 3 years of ownership. And then we also were able to procure an additional $700,000 credit for longer term items as well. HVAC repairs are covered 100% by the tenant. Based on our analysis, we think we might have up to 10 years of useful life remaining. And when we do recover the HVAC replacement, it's recovered over a 15-year amortization period from the tenants. So you can see the cost center in here of the HVAC replacement starting in year 7. We were just trying to be overly conservative in our analysis, so we'll have capital on hand to cover those expenses through reserves and these credits, but it's unlikely that that HVAC replacement would start at that point. Going into the tenants. So Biotechne, as I mentioned, big biotech firm, has several different business units, based in Minneapolis, although more and more corporate activity is actually occurring in this location. They've got a market cap of nearly $10 billion. They're publicly traded on NASDAQ. And they've got 2 main segments, protein sciences, diagnostics, and genomics. Looking at their overall footprint, they're in 72 different countries that they sell their product to. They operate in 34 different countries. And from a financial perspective, very strong company, nearly $1.2 billion of revenue last year. In the latest fiscal quarter, revenue grew. They continue to grow their earnings per share. Really, a lot of great margins across the business units for a company of this size. And so they do not have any public bonds right now, so they are not rated. But based on their financial strength, we feel very confident about their tenure within this building. They are in the building at least 3 days per week. There are certain business functions that go in more often than that. They are trying to push for a more consistent return to the office of 4 days a week, but they do not have a mandate for that yet. Looking at Quantum. So Quantum is the smaller of the two. Its market cap is 108 million. It was only 62 million a few weeks ago. It's a bit of a volatile stock because they have the name Quantum in the company. They operate in 15 different countries. And a couple things I want to highlight here. So this company's operated at a loss for the last few quarters. A big function of that is because they've started to exit the less profitable business lines. They've started to shut those down, as well as consolidating not only their workforce, but where that work is being done. And so this, again, speaks volumes about how important this site is. The R&D, the testing, the prototyping, and the IT hub for this company was done across 4 different countries. Now everything is done in this location. And so what we're starting to see is a change, an evolution in this company where now they're starting to have more recurring revenue through subscription models. You can see that surged 29% with their latest update. That's a high margin business for them. They're also really riding the wave of, as they see that cloud storage gets more and more expensive, and it's harder to fit in as not enough data centers are being built fast enough. They're a cost-effective alternative to that as well. And from a liquidity standpoint, one of our concerns was, well, what if they run out of cash before they fix this? They've secured a $200 million standby equity purchase agreement with Yorkville Advisors, which gives them access to growth capital and doesn't make them as reliant on existing debt. And again, I'm going to highlight that we have a $1.3 million credit from the seller that is just their earmark in case they default and we need to release this property, again, at a much higher rate. But if they don't default, and in our opinion, it's much more likely that they either have now right-sized their company and move towards profitability, or they are acquired by a larger competitor in the space. In either of those scenarios, we're keeping that $1.3 million credit, which lowers our overall investment basis. It's a win for us. I'm going to quickly go through the leases of both these properties. You'll see that there's annual increases for both Biotechne and Quantum. As I mentioned before, the vast majority of of these operating expenses are passed on to the tenant. And where it's not, we have already made capital reserves for any capital expenditures that we need. Same thing for Quantum here. You'll see 50-cent annual rent bumps. So a nice boost there. Again, it should be noted, and I'll highlight this again, the existing rents for both these properties are substantially below market today. Digging into the market itself, there's a lot of great information in the investment summary, more detailed than this. But Denver is a great top 20 metro area, 3 million plus population, continues to grow. It's got a great diversified employment base. You can see that overall among the largest metro areas, it's ranked number 7 in future growth, number 11 in prosperity. So we like Denver. We wanted to be in that market for a long time. And a lot of the macro trends for that market are continue to trend in the right direction. Also headquartered at 12 Fortune 1000 companies. Excuse me. Looking at the tighter area itself, where the subject property is located in Sentinel, if you look at it from a 5-mile radius, you've got great median household incomes over 100,000. You've got median home values of 600,000. You've got a lot of businesses concentrated in this area. If you looked at the aerial in the investment summary, you will see there is scores and scores of industrial and office facilities in that area, as well as a lot of retail and other supporting amenities. Now, the city itself has even stronger demographics than the immediate area, where the household income is 126,000 and 66% of all residents hold a bachelor's degree. Because of that, that's why it's such a hub for STEM jobs within the tech sector. Constantly ranked among the best cities there, safest, some of the highest rated schools, low crime, as I mentioned before, and great outdoor as well as other recreational appeals of that area. So really a very desirable area to be in within the Denver metro area. Okay, looking at the Denver office market on a, excuse me. At a very high level, the Denver office market is still struggling like a lot of office markets in the country. It's got a 25% vacancy rate at the metro area. It is still shedding office space. Now, the good news is rental rates have remained relatively consistent at 35.42 gross per square foot. Looking at this property in particular, the sales comparables show that we're buying this at the right on the right side of the ledger, with the average comp selling at $193 a square foot, where we're buying it at $155 a square foot, and that doesn't account for the millions of dollars in credits we're absorbing. On the rent side, our rents are under $14 a square foot. The most comparable comps that have been signed are at least 25% higher. The most recent comps are $18 to $20 a square foot, so 40 to 50% higher. And so we think having that below market rent puts us in a very good spot to reduce that risk of cash flow disruption, because the tenants don't have any other better alternatives in the market, especially after the improvements they've made for these properties. You'll see here at this bottom table that the that the submarket we're in the southeast has the highest submarket grade according to Green Street. Green Street is one of the largest data providers of commercial real estate information in the country. It's got the highest desirability index. It's got the highest income. It's got one of the highest concentrations of college educated folks, and it's a very business friendly environment. So we're excuse me, we're very happy about how we're positioned in that submarket. And as I mentioned, when you're looking at Class A flex office space in this market, that submarket vacancy for that property type is under 5%. When we surveyed local brokers about this and said, hey, if for some reason one of our buildings became vacant, what's the demand profile look right now? And he said, there's a waiting list of people to move in to properties like yours because we just have not built enough of them. And the fact that you have energy and cooling enhancements on the Quantum makes it even better. The chances of renting that property because of its improvements, the rates are actually even higher than what we're suggesting here, where they could be between $30 to $35 a square foot net because of those enhancements and the capability of half the building running as a data center. So again, another feather in our cap for why we like how we're positioned relative to the market on this deal. So to wrap up quickly about the investment terms, the minimum investment for this is $50,000. It's only open to accredited investors. The org chart on this, because everyone that's investing outside of the fund, you all set in a separate LP, so you don't have exposure to anything else in our fund. Our fund just invests alongside you. We make distributions quarterly. The preferred rate of return is 8.5% per annum based on unreturned capital contributions. If we pay above 8.5%, anything above that is a return of capital. The fee schedule, pretty straightforward, 1.25% acquisition fee, 50 basis point disposition fee, and a 1.25% annual asset management fee. The waterfall schedule here is pretty simple. After you have received your annual preferred rate of return and you've returned all of your initial capital contributions, profits are split 75-25 in favor of you, the LP, up to a 15% IRR. The next hurdle goes 70-30 in your favor. And then if we hit above a 20% IRR, it's 65-35 in favor of you, the LP. In terms of how the income distribution comes out, rent check comes in, we pay our debt obligations, we take the asset management fee, we pay the preferred rate of return, and then we return your equity, and then we move towards the profit split. So what's really nice about this deal and every deal that Sentinel does is that we current pay our preferred rate of return. As you probably noticed, the cash on cash was north of 9%. And so that allows us to current pay that pref. So there's no waiting, there's no catch up, there's no, boy, I hope we hit this number. This is how we've structured this deal, and this is why we are so selective on deals, so that we can current pay that pref, because we know you have options in today's investment marketplace well outside of commercial real estate. So we want to be compelling as commercial real estate. We want to be compelling against those other alternatives you have as well. So if this sounds interesting to you, again, this is only for accredited investors. If you want to reserve a spot, you just sign our indication of interest form. It's on a first come, first served basis. Now, we started this process a week ago, and we've already raised about 70% of the sidecar money available to non-fund investors. So there's about 1.4 million remaining. So if you haven't signed up and you're interested, I would sign up now. That indication of interest form is non-binding. We have a full suite of information, including the investment summary, which you may have already seen. We also happen to do a one-on-one meeting with you, with myself or our head of investor relations. And then once we're ready to go, we send you the subscription documents, operating agreement, everything else. And you review those, you sign those, we verify your status as an accredited investor, and then you wire those funds to us to the operating account to close on the property. Very important to note, this is closing soon. So we have a little over about 3 weeks or so until this deal will close. So we plan on making the capital call for this by the end of this week, and Laura can confirm the exact time frame. But because we wanted to get all our ducks in a row before we brought this out to the non-fund investors, the time frame is a little more truncated than what we usually do. So if you guys have any questions, I'm happy to take them now. I'm also going to put this up here. If you do want to complete your indication of interest form, just scan this QR code, and it'll allow you to reserve your spot in the offering.
Great. Thanks, Dennis. We did have a question come up just about the Waterpark office park in general, and what is going on with those other buildings in that park, vacancy-wise.
Yeah, great question. So the smaller, and I'm going to move back here. So if you need this QR code, I'll bring it back in a second. But there we go, right there. Okay, so building 4, which is the building on the left-hand side here, that's a northernmost building, that was sold to an owner user recently in the last 6 months or so at almost $180 a square foot. That building does not have any of the improvements our 2 buildings has. And all 4 of these buildings were owned by the same owner at once. And so he's doing a partial release with his lender on the 2 buildings we're acquiring, as well as the other one, so he can have a low balance on building 1. Building 1 is for sale, not for lease. It is vacant right now. It also doesn't have a high level of improvements in that building as well. But the seller is hoping he can obtain a price per square foot similar to building 4 and dispose of all these assets. We actually have a right of first refusal on that building. The seller themselves, though, doesn't have enough capital to offer a large TI package to a potential tenant. So even though there are groups that have expressed interest in that building to lease, the seller's undercapitalized and can't provide those incentives. So their only option right now is to sell to an owner user.
Great. One other question relating to the seller credits and the HVAC. Maybe walk through how that covers the HVAC
Sure.
and roof and maintenance again.
Yeah. So I'll go back to the seller credit here. So there's essentially $2 million in seller credits for capital expenditures. We think we've got about $1.3 million in cost or so in the first 3 years of the property, mainly for roof replacement and to resurface the parking lot, as well as a cleanup of the exterior facade. Beyond that, some of the items you'll see in here, like the elevator cab upgrades and elevator mods, those are in our schedule, but they're not required. And then when it comes to the HVAC replacement itself, there's a number of different HVAC units across these 2 buildings. We think the cost of those is about $375,000 a piece. So we're reserving our own capital, some up front, some from cash flow, in addition to the $700,000 that we're getting from the seller for that. Now, in this scenario, we just have it modeled out that replacement starts in year 7. And in reality, based on our analysis, that probably doesn't start till year 11. But we're trying, again, to be conservative in our underwriting. Once these are replaced, we essentially are putting the recollection of that cost on a 15-year schedule with the existing tenants. Now, the tenants obviously don't have 15 years of lease term remaining, even now, let alone in year 7. So it's only going to be a partial recoup of that unless they extend their leases. If they extend their leases, they're on the hook for that recovery as well. Does that make sense?
Thanks. Yep. Again, Dennis, if you'll put the QR code back on the screen, we are taking indications of interest, and it will give you access to our portal, which has a data room for you to download the full investment summary, and also take a look at the subscription documents. Everything is done through your portal. You can invest through your LLC or yourself, your IRA, your 401k. We will take it. We will take it all. And yes, you can do that. And then we just had one more question come through. As far as a composite return, this is, and Dennis, correct me if I'm wrong, this sits in its own LLC, so it'll have its own K1. There's nothing to do with the fund.
Yes,
yeah.
Correct. And I'll just go back to real quick here so you can see. So you can see here that Sentinel Waterpark LLC is the entity, the ownership entity, and it's basically owned by two different LPs. One is the fund, which again is not connected, and then the Waterpark LP. And the Waterpark LP investors on this, you will have your own specific K1 just for this property. There's no commingling of any type with our investors. It's the same way that you invest alongside all these other investors, and your K1s are not commingled as individuals. We're just separate buckets of capital.
Great. Another question coming in on Quantum and the vacancy, what's your confidence in releasing this in 6 months? I know you talked about that market having very little vacancy in this particular product. And I know you spoke with some of the brokers in the area as well.
Yeah. No, we feel highly confident about it. And part of that is because of our discussion with the brokerage community, including the brokers that leased these buildings to Quantum and Biotechny. And they just explain, look, you kind of have you have a little bit of the hole in the donut here, because we're surrounded by a lot of large office campuses, particularly in the Denver Tech Center. And these are 200, 300, 400,000 square foot multi-tenant buildings. And this area in Centennial is just this very unique concentration of smaller single tenant flex office buildings. And as you might imagine, if you have anything to do with the sciences, with engineering, with technology, it's a much harder fit to move into those traditional office spaces with those kind of needs that you have from an energy, from a cooling, gas perspective. And so these flex offices are really quite in demand. And so we feel highly confident about not only the releasing of it, but the releasing of it at a much higher price.
Great. Another question, and I'll read it out loud as it's written because I'm not sure I'm understanding. If distributions are held for Sentinel's reserves, is that process reflected in the 12% projected income numbers reported in the business plan in years 3 and beyond?
Yes. So every number you have, when we talk about net numbers, that is net distributable cash, and that is net of reserves. So in every scenario, when we're presenting information to you from a net perspective, that is what our projected distribution to the investors is. So as an example, we are, let me see if I can, I think I deleted the big cash flow from this because I didn't want to overwhelm anybody. But you'll see here, for example, that the total reserves is 3.6 million. So we have more than, and that's upfront, right? So that means that we're putting in more than $350,000 of reserves upfront. That's already accounted for in that return of capital. And so when you look at the net leveraged cash flow here that produces these return on invested capital, that is, sorry, that's the alternative scenario. That is net of those reserves that we would withhold from cash flow.
Great. And then another question.
This is
from
fun. I wish
Howard.
my voice was in better shape.
Another question from Howard was, will this be separate LLC, be pari passu with Sentinel Fund? And some of the terms are similar. I know this is, we have different classes in the fund, Class A and Class B. This is all one class, and I think you laid out the return profile.
Yeah, that's right. So this is essentially consistent with the Class A investor for the fund. So it's got a slightly higher annual preferred return, and it's got the more accelerated waterfall schedule that benefits the LP investors. The sponsor fees are pretty consistent with most investors in the fund have.
Great. One more thing related to the tax returns that we're getting on the composite. So if we provide a K1, and then if there are state taxes, then you have to file within that state. I'm not sure if Denver is applicable, Colorado is applicable to this, but if you were to have to pay taxes, we make the payment, and then it's up to your tax preparer on how you recoup that or not. And I think that is it for the questions. Again, we've got a little bit more in this to raise. So if you're interested, indicate your interest and we can get you over the documents immediately. Thanks for your time, everybody.
Thank you, everyone. Appreciate it.